Well, good afternoon, everyone. Thank you for joining, and welcome to Alvarez and Marcel's Tax Perspective webinar series in Australia, where our experts will bring you the insights on the latest tax developments. My name is Neil Pereira. I'm a corporate and international MD with experience in advising inbound and outbound multinational companies with tax structuring and planning, including collateral issues and APAs and tax controversy and disputes. I'd like to begin with an acknowledgement of country. In the spirit of reconciliation, Alvarez and Marcel acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. Our presenters today are Andrew Sharp, who leads the firm's private equity tax team and specializes in providing transaction tax advice. Mary Hu advises ASX companies and large corporates across a variety of industries. Amine Agazarian advises clients in corporate tax and tax governance. Joanna Black specializes in financial services tax and has capital markets experience for both publicly listed and private companies. And Amanda Spence is an Australian employment taxes expert and brings Big Four and corporate experience to advising clients. You'll find our speakers' bios in the chat during the webinar, and our bios will also be attached to the slides, which we'll send out following the webinar. Now, I'd like to take this opportunity to briefly tell you a little bit about Alvarez and Marcel. We're a global advisory firm with reach across the US, EMEA, the Americas, Asia Pacific, and in fact, globally where you do business. A&M started 40 years ago with restructuring services, but has grown to performance improvement, transaction advisory, and global tax services. Wait, can I just check? Can everyone hear me?
Other people can.
Yeah, good. So our tax team in Australia is made up of 22 tax partners across Australia with more than 80 staff. We're all ex-Big Four, bringing many years of experience and expertise across industries to advise our clients. The great thing is that we bring you points of view across all the Big Four, and we cover the breadth of tax services from complex advisory and transactions and structuring through to compliance across corporate income tax, employment taxes, GST and state taxes, and R&D and grants. We're also liaising closely with the tax office on matters of governance and the top 1,000 and top 500 programs. We're one firm globally, and we don't provide audit services, which allows us to be agile and responsive to our clients and to be hands-on with design, policy, and the implementation of our tax advice. And now on to our webinar. Whilst this is a presentation format, we have enabled the chat function. So if you do have any questions during any of the speakers' presentations, please put them in the chat and we will do our best to attend to them during the presentation or shortly thereafter. You may also be eligible for CPD credits for attending the webinar. And should you have any requirement for your confirmation of attendance, please contact us. Today's session will also be recorded. So if you do need to leave early or if you wish to view it again later, please feel free to share it with your friends and colleagues as well. So there have been many notable developments in Australia recently, and we've decided to focus today's session on the key topics of thin capitalisation, which will be covered by Andrew, Pillar 2, which will be covered by Mary, Public CBC by Amine, the AusNet, Minerva and Mylan cases by Joe, and employment taxes by Amanda. I'll now briefly cover royalty withholding tax and the ATO's draft software ruling. Royalties and withholding tax are a key issue for the OECD, and it's largely an industry agnostic issue when it comes to cross-border arrangements, but quite topical in Australia at the moment, as highlighted by the Pepsi and the Coca-Cola cases. Now, I won't go through this slide in a lot of detail, but just wanted to call out some of the key areas of focus when dealing with intangibles. Firstly, the assets should be identified with specificity. We often see in PPAs, for example, that they bundle assets into goodwill or generic category of brands. These do need to be split out. Secondly, characterization is critical, which requires an analysis of the essential character of the asset, not just its legal form in the agreements. And lastly, valuation and pricing is very important in a cross-border context. So I think the key takeaway here is that this is an area weighted very much by substance rather than just the form of the arrangements. However, care should be taken to ascertain both the substance of the activities, the DEMPI functions, as well as what rights are actually in the legal agreements. I'll now briefly talk about the new draft software ruling, TR 2024/D1, which was released earlier this year. noting that TR 9312, the ATO's previous long-standing ruling, was withdrawn on 30 June 2021. So the new ruling will have both prospective and retrospective application when finalized. This ruling will largely affect software distributors, although it may be broader in scope when you look at certain products. The key principle to consider is that the distributor is effectively put in the shoes of the copyright owner, because they enter into EULAs with customers to provide certain rights, and it is these rights which are the exclusive rights of the copyright owner. In this revised draft, the ATO has removed the 8 examples that were there in the previous version and now puts forward 3 broad scenarios, the first of which would cover most software distribution agreements in Australia. The first scenario encompasses the right to authorize communication of the software to the customer, which would be typical of a license key or a SaaS arrangement. And it's considered that this right, provided by the distributor, is an exclusive right of the copyright owner, which would make these distribution arrangements subject to royalty withholding tax. The second scenario envisages that the agreement lacks specificity in articulating the rights provided, but giving effect to the distribution agreement, the commercial context, and the agreement with the customer means that, in substance, these arrangements would be seen as the same as the first scenario and would be subject to royalties as well. The third scenario acknowledges that there may be other things and other important things provided for in the agreements between the copyright owner and the Australian entity. And as such, the payments may be apportioned, although as yet no guidance on apportionment has been provided in the ruling by the ATO or even in the Pepsi case. And lastly, while the ATO does point out that hardware with embedded software would be treated the same as the sale of software on any other physical media, the character of the payment does depend on the IP rights used or granted. So care should be taken where the hardware or device in question is cloud connected and subscription based. So in these circumstances, we make some recommendations. Firstly, that our clients carefully review and consider the legal rights provided in the agreements between the copyright owner and the distributor in Australia, as well as the EULAs with the customer, and form a view as to the characterization of any payment from the copyright owner, from the distributor to the copyright owner, as well as documenting and evidencing the basis of apportionment. One key factor to consider is where that EULA is between the overseas related party and an Australian customer. The MAL rules should be considered. I'll now pass to Andrew for his overview and insights on the new thin cap rules, which have recently received royal assent.
Thanks, Neil. Hi, everyone. Thank you very much for taking time out from your day to join us to talk about tax. I'm going to take you through in brief 10 minutes the new thin cap rules. But as you'll appreciate, these rules are complicated and 10 minutes doesn't really do them justice. And so to the extent to which anything piques your interest today or you want to drill down on it further, then by all means, reach out after this webinar and we can have a more in-depth discussion. But as many of you will know, what's happened is there's been a change between the historic balance sheet-based approach to determining allowable debt cover or debt deductibility in a taxpayer group to an earnings-based test. And so the default safe harbour debt test, which looks at the balance sheet of the borrower group and gearing allowable up to 60% of net assets on balance sheet, has been replaced with a fixed ratio test, which limits gearing to interest cover equal to 30% times tax EBITDA. The alternate tests have also been changed or tweaked. The worldwide gearing test, where deductions are allowed or where gearing doesn't exceed the global group's gearing ratio, has been replaced with a group ratio test, which limits Australian deductibility to what's called the group ratio multiplied by tax EBITDA. And then perhaps more importantly for a lot of us on this call, the historic arm's length debt test, which allowed for deductions up to the extent that gearing was an acceptable level for an arm's length lender into the group, has been replaced with what we call a third-party debt test, which limits the gearing to qualifying third-party debt costs. And the devil's in the detail with this one. Just a reminder, these rules apply with effect from 1 July 2023. And the results of these new tests are that they're more income-based tests. The calculations are slightly more volatile. The debt capacity can fluctuate with earnings and one-off expenses like realised gains or losses and write-offs, unless the third-party debt test is applicable. And it's got more barriers to entry than its predecessor arm's length debt test. So it's more difficult to right-side debts for transactions for working capital facilities without losing deductions. The fixed ratio test, the 30% of tax EBITDA test, applies by default, and it applies a clear 30% limit on allowable gearing. There is the ability under this test to carry forward denied debt deductions, kind of like carrying forward tax losses. And there is the opportunity with this test to share capacity across taxpayer groups in a global structure. The first alternate test, the group ratio test, can be a little bit difficult for investee entities of offshore fund managers, for example, to opt into, because if you account for a subsidiary in Australia on an investment basis, then it's generally the case that it's not possible to use gearing capacity in one portfolio company of an offshore fund as to offset the gearing capacity of another. There's complexity in these tests. They require complex group calculations and data gathering. And unlike the default test, there's no allowance to carry forward debt deductions into future. This is a permanent denial. The second alternative test, the third-party debt test, is a bright line test. And so where all group debts qualify, this test shouldn't deny any deductions. So on one view, it's less volatile, but the conditions required to qualify for this test are difficult, and certain common commercial arrangements may not qualify, and care should be taken to determine whether or not this test is applicable to your taxpayer group's facts and circumstances. Again, unlike the default test, there's no allowance for carry forward of deductions under this test. It's a permanent difference. So what you need to do, you need to work out whether you can apply the test in the first place, which will be fact and circumstance dependent. And then it's worth analysing at that point whether or not the chosen test will result in a consistent improvement, noting that there's denial under the alternate test. I want to drill in on the third-party debt test, which replaces the arm's length debt test, because there are some pairs in this one. Each loan into a borrower group is tested under these conditions listed on this slide here, and one can only deduct interest expense if the relevant loan meets all of those listed conditions. So firstly, the lender needs to be a genuinely unrelated party of the borrower, and related party for these purposes means 20% commonality of ownership. Secondly, the recourse that the lender has needs to be limited only to the Australian assets of the borrower group. So you're not allowed to have security over foreign shares or assets. The borrower can't give security over its own shares if it owns shares in a foreign subsidiary or assets. And credit support rights, other than in very limited circumstances, are not allowed. There are exceptions for minor or insignificant assets, but there's no guidance on what minor or insignificant means for these purposes, and there's no safe harbour. The funds need to be used for certain purposes, so essentially the borrower needs to use all or substantially all of the debt funding to fund commercial activities in Australia. Borrower is not allowed to use bank debt to fund foreign branch operations or foreign subsidiaries. And lastly, the borrower must be an Australian entity to rely on this test. If any of those conditions is failed, then all debt deductions are permanently disallowed for that loan. Now, I want to drill in on the recourse considerations relevant to this test, because in my view, this is a sleeper way for Treasury to have essentially removed the concessions that 2590 allow taxpayers by an alternate means, essentially making debts uncommercial in circumstances where they give rise to deductions and the debt is used for the purpose of funding foreign operations. So in the slide here, you can see that the bank is allowed to take security only over the assets of the Australian entity, the Portco in Australia. The bank is not allowed to take a parental guarantee from the offshore owner of the Australian entity that's subject to FinCap. The bank is not allowed to have security over the New Zealand subsidiary's assets. It's not allowed to have security over the shares in the New Zealand subsidiary. And indeed, as is commonly the case, banks would like to take security over the Australian borrower's shares in itself, not allowed to do that either under these rules, lest that entire tranche of debt be exempted from availability of the arm's length debt test, or its new third-party debt test. And so just want to reiterate that recourse has become a big issue with ordinary commercial debt, where to the extent that the borrower group is not eligible to rely on the 30% of tax EBITDA test and wants to rely instead on the alternate replacement of the arm's length debt test, third-party debt test, it can only do so in circumstances where recourse under the debt is limited. And so really fascinating way that these rules operate. I also want to touch a little bit on the debt deduction creation rule. This is well, I was going to say a tack. This is another means by which shareholder loans are being discouraged by Treasury. So essentially this debt deduction creation rule denies debt deductions if any debt is used to fund acquisition of assets from a related party, or to fund distributions, loan repayments, or other payments made to related parties. There's no carry forward of denied deduction, so this one is again a permanent difference, and there's no application of applying the third-party debt test in these circumstances. There are certain exceptions, including the funding of the issuance of new shares, purchasing tangible fixed assets, or related party on lending. But this one has some issues. There's no grandfathering of historic arrangements. And so it's going to be incumbent upon taxpayer groups that have in situ a capital structure that includes shareholder loans that's been in place for however long it may have been in place for. It'll be important to work out what the funds were originally used for, the original purpose. And so that comes with a compliance burden to determine how to trace and apportion the original use of the related party financing. Common commercial transactions are potentially caught within the ambit of this debt deduction creation rule, or DDCR. And there's no purpose test. If the conditions are satisfied, then denial is the result, with or without an intent to create deductions. We think that ATO guidance on this rule is going to be essential to understand whether or not it's possible to restructure out of historic non-grandfathered arrangements what were the original funds used for, et cetera, and how taxpayers are able to trace the historic use of those funds. Just want to quickly talk about two potentially at-risk situations caught by these new debt deduction creation rules. On the left, we have a common real estate holding structure where offshore investors may have advanced funds to an Australian holding trust, which may have advanced those funds into a subsidiary prop trust that holds property. To the extent to which those funds are used to acquire property from a developer co or to fund a distribution by the prop trust, then those borrowings are at risk of being denied under the new DDCR. And secondly, funding from offshore into an Australian group to fund a dividend, a loan repayment, capital return, a buyback, a redemption of shares, or pay a royalty in that arrangement to another company are all potentially caught by the DDCR, and those advanced shareholder loan funding would be ineligible for debt deductions in the Australia group. So I've whizzed through a lot very briefly. I just want to leave with you that these new tests, it's worth spending the time to weigh up which of the tests is appropriate for your taxpayer group, having regard to the industry you're in, your margins, your funding mix, and your historic tax attributes. The DDCR is a sleeper. It's worth investigating any historic exposures to the extent to which you have or have had shareholder loans in place in your taxpayer group, and consider the ramifications for acquisitions in the future. And it's important to build in new ThinCap modelling or ensure that the third-party debt conditions are considered into your compliance program and tax policies, getting ahead of the impact of the new rules and strategising on how best to mitigate their impacts. Thank you for listening, and I'll hand over now to my colleague Mary, who's going to give you an update on Pillar 2. Thank you very much.
Hi everyone, thanks Andrew. So today I'll be going through the recent exposure draft legislation that was released by Treasury in March in relation to implementing Pillar 2 into Australian law. Pillar 2 has been a long time coming, so it's great to actually finally see some clarity on what those rules might look like in Australia. The draft legislation included 3 bills, a consultation paper, as well as subordinate legislation, otherwise known as the rules. Submissions were due on the 3 bills and the consultation paper last week. However, there's still some time to comment on the rules. Pillar 2 will apply to multinational groups with turnover of €750 million or more in the last 2 out of 4 income years. This is similar to the significant global entity test, but isn't quite the same. So significant global entities still need to work out whether they satisfy the Pillar 2 thresholds. In Australia, it's been confirmed that we'll be introducing 3 top-up taxes. So the domestic minimum tax, the income inclusion rule, and the undertaxed profits rule. Domestic minimum tax seeks to apply top-up tax to where the Australian entities in the group have an effective tax rate of less than 15% pursuant to the Pillar 2 rules. The income inclusion rule is the primary mechanism for collecting top-up tax around the world outside of Australia. It operates like a CFC regime, so your ultimate parent entity is responsible for collecting tax in any jurisdiction that has effective tax rate of less than 15%. The undertaxed payment rule is also known as the backstop measure. So it will apply when the income inclusion rule and the domestic minimum tax, don't apply. At the moment, there's very little detail on how the UTPR will work. However, based on latest OECD guidance, it looks like it'll take the form of the denial of a deduction based on relative employees' intangible assets. For those subject to Pillar 2, they'll be required to lodge 3 new tax returns. So firstly, the Globe Information Return, which is a standardised return similar to a CBC report, which will be exchanged between revenue authorities. In July 2023, the OECD released some guidance on the types of disclosures that might be included in the Globe Information Return, and the sample return in that document extended to 28 pages. So there's a significant amount of information there, which isn't just limited to income and taxes paid, but also information about the general corporate group. Some of those disclosures also include entity by entity information rather than just simply information on the group level. There's also the Australian Globe Tax Return and the DMT return, which are Australian specific returns that are mainly to provide the ATO with sufficient information in order to assess the top-up tax. It's also been proposed that penalties for failure to lodge will be increased to 500 times, consistent with significant global entities. Head companies of consolidated groups will be liable to pay top-up tax on behalf of subsidiary members. In relation to franking credits, Treasury is currently proposing that it will allow franking credits for the domestic minimum tax, but not for the income inclusion rule or the undertaxed payment rule, as they view those taxes as international taxes rather than domestic taxes. In the consultation paper, Treasury also sets out suggested interactions with the FITO, hybrid mismatch rules, CFC, and foreign hybrid rules. So as you can see from this slide, the timing of these measures is incredibly tight. So for the domestic minimum tax and the income inclusion rule, these will commence from 1 January 2024. The UTPR will be delayed by 1 year to commence on 1 January 2025. First filings will be due 18 months after the first income year. So for 31 December 2024 taxpayers, those will be due on the 30th of June 2026. And for taxpayers who are seeking to rely on the transitional safe harbour rules, they will have until 30 June 2028 to do so. The key takeaway here is that even though the Pillar 2 rules haven't yet been enacted, given the tight timing and potential retrospective timing, it'll be important to familiarise yourself with the rules to ensure that you can satisfy your compliance obligations, especially given the potential significant penalties. So how does Australia's timing compare to the rest of the world? So the 1 January 2024 timing is aligned with countries like the UK, South Korea, Canada, and also countries within the EU. However, in Asia, Australia is actually one of the first movers. So if you compare to countries like Japan, they won't be starting their rules until 1 April 2024. And Singapore and New Zealand won't be starting their rules until a year later in 1 January 2025. Importantly, the US still hasn't made any public announcements yet on when it's planning to implement the Pillar 2 rules. So it's very much a wait and see, and it may be until the election in November before we find out any further. So the reason it's important to monitor where countries are at with their Pillar 2 implementation is because the outcomes of who pays the top-up tax can differ depending on the ordering of the implementation. So the purpose of this example is to illustrate what would happen if you've got countries implementing Pillar 2 at different times. So here we've got a multinational group where we've got the head company in country A, with subsidiaries in country B, C, and D, where country D is a low tax jurisdiction. Ordinarily, it'll be Holdco as the ultimate parent entity who will be responsible for collecting top-up tax under the income inclusion rule. However, if country A hasn't yet implemented the income inclusion rule, then it will be country B and country C, their responsibility to collect the income inclusion rule top-up tax. So, for example, if country B and C are Australia and South Korea. You might also notice that on the right-hand side, there's a company DCO 5, which is directly held by Holdco, but isn't held by BCO and CCO. That top-up tax won't be collected by Holdco, as country A doesn't have an income inclusion rule, however, could be collected under the undertax payment rule. This slide just provides a very high-level guidance on how the Pillar 2 process works. So firstly, it's important to identify whether your group is actually within scope and to determine the location of each constituent entity within your group. So you might have heard that certain entities are actually excluded from the Pillar 2 rules. So entities such as certain investment funds, real estate investment vehicles, pension funds, government entities, and not-for-profits. So it's important to work out whether your entity is actually an excluded entity, even if you do fall within the 750 million euro threshold. The next few steps relate to calculating the effective tax rate in each jurisdiction. So you start with globe income, which is based on your financial reports. However, that needs to be adjusted by various adjustments in order to align it closer with the tax base. In relation to covered taxes, this relates to income taxes, both current and deferred. In relation to deferred taxes, this is recast at a 15% tax rate. And then finally, you would then add up all the income and taxes for your constituent entities in a particular jurisdiction and calculate whether that particular jurisdiction has an effective tax rate of 15% or less. It's important to note that even though your jurisdiction could have a headline tax rate of more than 15%, the tax base for Pillar 2 is completely different to your taxable income tax base. So it's important to do the work and understand whether there's any Pillar 2 exposure. As I mentioned earlier, certain entities might be able to apply the safe harbour rules up to 30 June 2028. These safe harbour rules rely on CBC reports that are prepared using qualified financial statements. So the key call out here is that you need to make sure that the data that you're currently using for your CBC report is actually sourced from your financial statements, as otherwise these rules won't be available to you. And if they do apply, they will allow you to deem the jurisdiction to have top-up tax of 0. So it's a pretty favourable safe harbour if you can get in. So the key actions I want you to take away is that, firstly, you should make sure that your group is in scope and to identify whether you're an excluded entity, where your constituent entities and jurisdictions are. You should also assess whether there are any low tax risks for your jurisdiction and estimate any potential top-up tax exposure. And then finally, but also importantly, it's important to address your compliance obligations, including the availability of any safe harbours, and establish processes for collecting the data that's necessary in order to satisfy your lodgement obligations. Thanks everyone, and I'll now pass over to Ame.
Thank you, Mary, and good afternoon to you all. On the 12th of February of this year, the Australian government released draft revised legislation requiring M&E groups with a presence in Australia to publicly disclose certain tax information on a country-by-country basis, as well as to publish a statement on their approach to taxation. The original draft was released in April of 2023 and was subject to feedback. The revised draft legislation incorporates some of that feedback from taxpayers in the community and better aligns these new rules to the OECD guidance as well as the European Directive on country-by-country reporting. The updates to the new law include, firstly, certain additional disclosures that were flagged in the previous draft and have now been removed. These were disclosures of related party expenses, the effective tax rate disclosures, and the requirement to list tangible and intangible assets along with their book values. Secondly, the introduction of a materiality threshold such that the country-by-country reporting parent is only subject to the public reporting obligation if the entity's aggregated Australian source turnover for the income year is $10 million or more. Thirdly, there is now a requirement to publish information on a country-by-country basis for certain specified jurisdictions and on an aggregated basis for remaining jurisdictions. And finally, the new rules align the commencement period to the reporting period for what has been implemented in the European Union. So why have these new measures been introduced? The new law aligns to OECD guidance on greater transparency. The purpose and objective of these rules is to improve information flows, to help the public and investors compare the entity tax disclosures and better assess whether an entity's economic presence aligns with the amount of tax that they pay in that jurisdiction. And how does this compare to what the rest of the OECD are doing? The European Union released EU Directive 2021-2101, which was adopted into the domestic law of the EU states last year and will take operation from income years commencing June 2024. Australia's public CBC rules come in the wake of the European Union introducing these measures to align with the OECD guidance. However, the Australian rules are at this stage the most comprehensive. So who do these rules apply to? The new rules apply to all MNE groups that have a presence in Australia and have a global consolidated revenue in excess of $1 billion, and where the entity or another member of the CBCR group is either an Australian resident or a foreign resident who operates an Australian permanent establishment. The reporting obligation rests with the reporting parent entity or global parent entity, regardless of whether that entity is an Australian resident. As mentioned, there is a new de minimis threshold, and as such, the country-by-country reporting parent is only subject to the public reporting obligation if the entity's aggregated Australian source turnover for that income year is $10 million or more. This measure should exclude those multinational groups that have smaller operations in Australia. So what do groups need to report? At the outset, and for all reports that need to be made, the CBC reporting entity is required to disclose its name and the names of each of the entities in the CBC reporting group, along with a description of the country-by-country reporting group's approach to tax. Guidance for the concept of an approach to tax is provided in Standard 207.1 of the Global Reporting Initiative, and the new draft law points to this standard for interpretation of this concept. Broadly, per the standard, the approach to tax should include an organisation's tax strategy, who the governance body that reviews and approves the strategy is, for example, the board of directors, the frequency of the review, and the organisation's approach to compliance and how the approach to tax is linked to the business and sustainability strategies of that organisation. Now, moving on to some of the more specific reporting requirements, the required public disclosure requirements are separated into two categories. Information that will need to be disclosed on a separate country-by-country basis for entities that are in specified jurisdictions, and information that can be presented on an aggregated basis for those entities that are not in specified jurisdictions. Further, country-by-country reporting entities can choose to provide greater transparency and publish their disclosures for all of their jurisdictions on a separate country-by-country basis. So, specified jurisdictions. Currently, there are 41 specified jurisdictions, which include Singapore, Hong Kong, and Switzerland. Per the explanatory memorandum to the new law, the jurisdictions specified are those that are typically associated with tax incentives, tax secrecy, and other matters likely to facilitate profit shifting activities. The list of countries broadly aligns with the list adopted for the purposes of the IDS specified countries, but does exclude jurisdictions in the European Union, which may be subject to the EU's public CBC reporting regime. So these entities are the Netherlands, Cyprus, Ireland, and Luxembourg. The information that's required to be published on a standalone and aggregated basis is largely aligned. However, the main difference is for specified countries, there's a disclosure that needs to be made to explain the difference between what the tax would have been if the applicable tax rate of that jurisdiction were applied to the profit or loss before income tax, compared to the actual income tax accrued for that year. And an explanation will need to be provided for these differences. This specific disclosure is not aligned with OECD guidance or the EU directive, and as such is specific to Australian tax law. Lastly, the information published must be sought from audited financial statements, and if audited financial statements are not available, the figures published must be such as if they were sourced from audited financial statements. So when do these new rules potentially come in? The first reporting period will be for income years commencing on or after the 1st of June 2024 and will be due within 12 months of the end of that income. So for a 31 December year end, the first reporting year will be the year ended 31 December 2025, and the report will be due by 31 December 26. So that's 12 months after that year end. Companies are not expected to self-publish this information. Rather, an ATO submission form is contemplated to be released, with the ATO then collecting this information and publishing it collectively on a government website. And what happens if there is a failure to comply? Measures have been put into place for failure to comply, including penalties for non-lodgement, late lodgement, or lodgement with incorrect information. Large fines can be imposed for all three. However, taxpayers can correct errors in their reports within 28 days of becoming aware of these errors without a penalty. So what can you do to prepare if you are caught within these rules? Firstly, review your tax governance framework, specifically to ensure that robust governance is in place and that you have a board-approved approach to tax. Consider whether you can meet the standards under GRI Standard 207.1. Consider whether you have any presence in specified territories and what information you will need for the public country-by-country disclosures. Consider implementing processes for the preparation of this information in advance. If you have potential crossovers on reporting, for example, with the EU directive or with the Voluntary Tax Transparency Code, consider whether you can leverage any of that information and also ensure that your public disclosures are aligned and consistent. Lastly, I think the main takeaway is that these rules are comprehensive and far-reaching, so early planning and discussion amongst your group will be essential. Thank you for your time. Please feel free to reach out to us with any questions on public CBC. And now I will pass you on to Joe Black to provide you with an update on recent tax cases.
Wonderful, thanks, Avani. So as if all these legislative changes weren't enough, the courts have been busy with some important tax decisions recently. Today we're going to take a look at the AusNet rollover decision and two Federal Court Part 4A decisions handed down in March. So the AusNet case involved the top hatting of the previously triple-stapled AusNet group, achieved via 3 successive share and unit exchanges, which are shown as 1, 2, 3 on that second diagram, and implemented via schemes of arrangement. The ATO back in 2015 issued a class ruling confirming that DIP 615 rollover applied to each of these 3 exchanges, and this effectively meant that the top hatting would be tax neutral for ultimate shareholders who received replacement shares in the new head company with historic cost bases rolled over, and also neutral for the new head company AusNet Services, which would also inherit into historic cost bases in the shares or units acquired and the underlying assets. Several commentators have described this case as a case of rollover regret, in that AusNet subsequently realised it could do better than this and angled for 124M, applying instead for the third entity in the staple, which was distribution, and which happened to hold significant depreciating assets. So a market value uplift under 124M would have been pretty useful. However, looking back at the tax summary in the 2015 scheme booklet, it states Division 615 or Subdivision 124M would apply in respect of that third exchange. So I guess there was always the hope on AusNet's part that 124M would or could apply, and this was finally tested and rejected by the Federal Court. This case clarifies several key points about Division 615 and other rollovers, which are relevant beyond this unique stapled structure restructure. First, and most obviously, Division 615 will apply in priority to 124M, where both potentially apply. This one's not surprising. This priority is explicitly written into the Act, and there are various integrity provisions designed to ensure that 124M does not apply to genuine restructures. However, the court's decision in AusNet supports the approach that we've seen from the ATO on transactions going back a number of years, being that the ATO will strongly encourage a Division 615 outcome wherever possible, rather than allowing 124M and the associated cost base uplift. The decision is also helpful in the interpretation of the nothing else requirement in Division 615, which requires that shareholders receive replacement shares and nothing else in order for the rollover to be available. AusNet argued that in distributions case, so that third entity only, the nothing else requirement couldn't be satisfied as shareholders gained something else other than replacement shares, being an alleged increase in value as a result of AusNet's prior acquisition of the other two stapled entities. I think rightly so, the court rejected these arguments and took a narrow view of the nothing else requirement, focusing on the drafting of the scheme implementation deed, which provided that shareholders only received replacement shares as consideration. There was no something else. This highlights the importance of drafting those transaction documents to achieve the desired rollover and tax implications more generally. And of course, the same goes for private transactions implemented by contract. In a similar argument, AusNet argued that 615 rollover was not available because AusNet was not a shelf company, as by the time it got to the distribution exchange, so that third exchange, AusNet had already acquired the other two entities and was a company of significant market value, meaning that the proportionate market value requirements in Div 615 could not be satisfied. The Federal Court found that there is no strict requirement under Div 615 for the new interposed company to be a shelf company, and that it is possible for the market value ratio requirements to be satisfied even if an interposed company has significant value. And this is done by comparing the relative proportionate interest of exchanging members in the market value pre and post restructure, so effectively ignoring any pre-existing value in that interposed company. So in terms of the practical consequences of this decision, despite references to a shelf company in various relevant headings and notes in the Act and in the ATO's old ruling on the top heading rollover, it was generally understood that there was no strict requirement in Div 615 for the interposed company to be a shelf company. And this was the position of the ATO in several recent transactions. So probably not much changes on a practical level here. And while in theory, this decision does open doors to using existing and valuable companies as a new head company where this suits the overall objectives of a restructure, I don't actually think this decision will markedly change the practice. In particular, in any groups which have dutiable assets and are looking to restructure, a freshly minted company will be required due to strict dormancy requirements under the duty reconstruction relief in the various states. However, the case is helpful in its narrow interpretation of the nothing else requirement, not only for Div 615, but for other rollovers, including demerger relief under Division 125. And importantly, this case narrows substantially the wider view that the ATO has tended to take of the nothing else requirement in that context. The decision is also helpful in structuring and sequencing interdependent and complex transactions across the board. The court clearly acknowledges that even where transaction steps occur all on the same day and are interdependent, there is a brief moment after each step where it is possible to test whether rollover conditions are met and for rollovers to apply successively. The issue for AusNet in this case was that the court just didn't buy that you could, at that moment, apply the market value ratios in the way that AusNet suggested to structure out of Div 615 and back into 124M. AusNet has lodged an appeal to the full federal court. So now looking at a case where a taxpayer is structured into a staple rather than out of one, but a case that has important ramifications across the board in its Part 4A analysis, and looking at the recent Minerva Part 4A decision, which we understand that the Commissioner has not applied for special leave to the High Court to appeal. So this full federal court decision, which I'll discuss, will stand. So in terms of the facts for this one, Liberty Financial Group in 2007 undertook a restructure to convert into a stapled structure in preparation for an IPO with a trust silo and a corporate silo. All new securitisation trusts were held under the trust silo, but 2 of the Australian companies on the corporate side held special units in the holding trust. The trustee had a discretion as to whether to distribute the securitisation trust income to the companies on the corporate side, which would ultimately attract a 30% tax rate, or to the head trust on the trust side, which would attract a 10% interest withholding tax. The proposed IPO was pushed back numerous times due to economic conditions, and in the subsequent years, the trustee determined to distribute the bulk of the income to the trust side and a de minimis amount to the companies. The Commissioner alleged Part 4A, both to the restructure itself and to the trustee's determination not to distribute income to the companies. The federal court, so the lower court in this case, accepted that Part 4A did not apply to the restructure itself, and the Commissioner did not seek to challenge this finding on appeal to the full federal court. Importantly, Liberty was successful on this argument largely due to the strength of evidence around the restructure presented by external advisors and documented contemporaneously that the restructure would result in a structure which was attractive to investors and improve transaction pricing and valuation on IPO, even if those commercial benefits were a result of being responsive to the tax attributes of the proposed investor market. So, having accepted that the pre-IPO restructure did not attract Part 4A, the full federal court found that the payment of distributions in accordance with the terms of the units did not point to a dominant purpose of a tax benefit. Importantly, Minerva's case at first instance had failed on this distribution point due to a lack of evidence as to why the trustee only distributed nominal amounts to the companies, and therefore the Commissioner was successful in arguing that it must have been to obtain a tax benefit at first instance. This issue was resolved on appeal, as the full federal court was presented with evidence as to the non-tax benefits of paying distributions in this way, primarily allowing the repayment of debt and increased capital investment on the trust side. Given these commercial benefits, the court didn't accept that the trustee should have distributed to the companies with a higher tax bill. It feels like an obvious point, but this case again demonstrates that Part 4A cases rise and fall on the strength of the evidence. And the best kind of evidence is contemporaneous to the transaction and objectively evidences the benefits of that transaction. In this case, it was advice from advisors setting out the commercial benefits, strategic directives, and the objectives at board level. This is very similar to the analysis by the court undertaken in the federal court in the subsequent case of Mylan, which considered the application of Part 4A to debt deductions in a consolidated holdco-bidco structure established to fund an Australian acquisition. The court concluded that Part 4A did not apply because although a tax benefit was achieved, being the debt deductions from debt funding the acquisition in a particular way, there were good reasons for debt funding the acquisition in this way other than an Australian tax benefit. There was evidence of a US tax benefit in this case, so it's likely this fact pattern wouldn't fare as well if the government amends Part 4A as contemplated in last year's budget. Similarly to Minerva, the judgment in Mylan frequently refers to contemporaneous documents to understand Mylan's intentions at the time of the transaction, and also notes where there's a lack of that kind of evidence. The court's finding in Mylan that holdco-bidco structures are unremarkable from a Part 4A perspective is a significant win for taxpayer groups with these structures, or indeed any shareholder debt, particularly given the Commissioner's long-standing suggestion that these kind of structures attract Part 4A as compared to pure equity funding. However, care should still be taken with shareholder loans given the other rules which can apply, including the new debt deduction creation rules, which Andrew mentioned earlier. So, importantly, although we understand the Commissioner will not appeal Minerva, undoubtedly the Commissioner will appeal Mylan, and there will be further commentary on holdco-bidco structures and shareholder loans more generally. So important to watch that space. I'll leave you now with some key actions you can take arising out of these cases before passing on to Amanda to wrap up.
Thanks very much, Jo. So I'm now going to talk about a couple of employment taxes points. As we've had for everyone today, we've only got about 10 minutes to go through some employment tax points. So while I've got time to bring you up to speed with some recent changes, unfortunately we won't be going into a great level of detail. First thing I wanted to talk about here are, some employee and contractor issues that we've been looking at. So the first rule I want you to remember is that you can either only be a common law employee or an independent contractor. That list isn't exhaustive. There are other options, but they are mutually exclusive. You can only be one or the other there. You can't be both at the same time. Second point I wanted to talk about today are the recent cases of personal contracting and JAMSEC. Out of those cases, we found that the legal rights and obligations of the parties are what should be used to determine a worker's status. So we need to look at things like the control that each level, the level of control that each party has in that arrangement, where and when the work is being performed, also who gets to decide where and when the work is being performed. And then also, essentially, is the worker providing work for their own business to build up their own business, or are they really working for the benefit of the person that's being engaged to them? So what we're looking at there, you're probably familiar with those sorts of terms. It's what we used to call the multifactorial test or the entrepreneurship test. However, what the cases have told us is the importance of the contract in assessing these factors. So if we put aside sham contractors or situations where facts perhaps have morphed over a period of time, the two cases have found that the terms of the contract are what should be used to determine the status of the worker. There is no need to view the practicality of the engagement by assessing the real-life enactment of the contract. And so, at the end of last year, we're in the position where we could say quite confidently, the contract is king, provided all the legal rights and obligations of the parties are accurately documented in the terms of the contract, then we don't need to look any further. It's just the terms in the contract that we use to determine the nature of the relationship. But then, along came the second bill for the closing the loopholes legislation. Now, under Bill number 2, an employee is defined to be ascertained by examining the real and practical nature, the real substance and practical reality and true nature of the relationship between the parties. You need to consider not only the contract, but also how the contract is performed in practice. So what is important to remember there is the closing loopholes legislation is enacted through the Fair Work Act rather than the tax law. So if we go back to that first rule I said, that said you could only be a common law employee or an independent contractor, it's only about 2 minutes later, and I'm already going to tell you that we're going to break that first rule. So when the Fair Work legislation comes into play, it will be possible for a relationship to be viewed one way for tax purposes when you're solely looking at the contract, but possibly another way when you consider the totality of the relationship in both the context of the contract and a practical reality. So what does that mean for our employers? It really means you need to have your ducks in a row. You need to absolutely have a contract that will always be of vital importance, but you do need to have regular checks to make sure that the practical reality of the relationship is what's reflected in that contract as well. So now that we've talked about the difference between common law employee and independent contractor, I'm sure we've completely demystified that for you. What I'd like to talk through are a couple of the main issues that we're seeing lately in the market with respect to contractors, and I'd like to dispel a couple of myths as we go through. So what I think most people would be aware of is superannuation applies to common law employee payments. So we've got them covered there. The myth I'd like to dispel is that superannuation only applies to common law employees. So under the superannuation legislation, the definition of employee is extended to cover a series of additional categories of workers. One of those is independent contractors that are engaged wholly or principally for their labour. So you can have an independent contractor absolutely genuinely working for their own business. They're not a common law employee under any definition, but you might still be liable for superannuation with respect to their payments and their services. It's quite old now, but SGR 2005/1 provides the ATO's view on when an independent contractor could be deemed to be wholly or principally engaged for their labour. The recent cases I also mentioned have really added to our understanding of this as well. They are aligned, but we would be very happy to talk to you if you have any questions or any particulars around your particular contractor arrangements. The second myth I want to talk about today is payroll tax. Again, we're going to start with the same basis that most businesses are aware that they have to pay payroll tax on payments to common law employees. However, I frequently speak with businesses that assume that just because someone is an independent contractor, there is no payroll tax that needs to be paid on that. Unfortunately, the reality is not quite there. So when we go through the process, you may find that you don't actually need to pay payroll tax on a great deal of your contractor payments, but it is necessary for businesses to start from the position that all payments to contractors are subject to payroll tax, and then document which exemption applies, depending on what jurisdiction they're in, to exclude the payments from the annual reconciliations. Sorry to say the first year that you do this is usually quite a manual process and can take some time. But I promise in subsequent years it'll be much quicker, as you only need to do a little bit of a top-up check for new contractors and just make sure the assumptions you've applied in previous years still apply to the contractors you have on hand. So if nothing else, what I'm hoping you'll take away from this brief update today is this slide, this picture here. So we're all comfortable on the left. So superannuation and payroll tax are applicable for payments to common law employees. It's the box on the right that we need to look at. So you can have 4 different scenarios that we're looking at here. If you've got an independent contractor, you may have to pay superannuation on them. You may need to pay payroll tax with respect to them. You may need to pay both, or you may need to pay neither. It is important though that you do that analysis. You can generally wait until you do your year-end annual reconciliation for payroll tax purposes to understand which exemptions may apply for them. But if you do have a superannuation obligation, you'll need to make sure you meet your quarterly deadlines for them. I'd strongly suggest that any payroll tax and superannuation analysis is part of the onboarding process, just to make sure that you've got everything aligned with that contract from the very beginning. So a couple of key actions for the independent contractors. Absolutely, you need to review contract arrangements and make sure that you've got comprehensive contracts in place that not only describe the contract in technical form, but also match to the practical realities of the contract. Do identify if you've got any contractors that would be subject to superannuation under the extended definition of wholly or principally for labour. And then obviously the last point is around payroll tax. So make sure you build that repository for the exemptions that you've applied for all of your contractors. And because it's FBT season, just a couple of minutes at the end here that I'd like you to keep in mind when you prepare your 2024 FBT return. First of all, the 2024 FBT year was a leap year. So if you do have any in-house workbooks, do make sure that you've updated the number of days in the year to be 366. I'm also pleased to confirm that if you lodge your FBT return with A&M, there'll be a deferral of both the due date for balancing payment and lodgement to the 25th of June. There's been a lot of work and a lot of communications out on the EV space for FBT purposes. So I'll just give you an update that the PCG 2024/2 is the finalised version that gives a home charging rate on a cents per kilometre basis that you can use. And then just a couple of looking forward points. So bear in mind that from 1 April 2025, plug-in hybrid vehicles will be excluded from the definition of the FBT exemption. So do bear that in mind. Also bear in mind that for any ESG reporting that you're looking forward to as well. And then unfortunately, the alternative record keeping legislation was not passed by the end of the 2024 FBT year. So we are expecting it to be in place for the 2025 years, but it's not in place just yet for the 2024 returns. Thanks very much, everybody. With that, I'm going to hand back over to Neil.
Well, thank you, Amanda. Thanks, everyone, for joining us today for our very first webinar. We really appreciate your support. We trust you found it informative and valuable. And thank you very much to my colleagues speaking today. Please see links to our tax bulletins and thought leadership for your convenience. We'll shortly be sending out the slides of the session, and we'll address any questions we didn't get to during the webinar. If you do have any further questions or would like to know more, please don't hesitate to contact any of the speakers directly. We look forward to seeing you at our next webinar, and we'll provide details of that upcoming event soon. Have a great afternoon, and thank you.